Hey everybody, in this video we're talking about monetary policy in the ASAD model. Here at Econ Busters, we're trying to push kind of a new paradigm, a new way of teaching monetary policy with the ASAD model. Now we already have a few videos out there that I invite you to go watch. In this video we're getting a little bit more complex, okay? We're adding in the LRAS curve. And I want to say right from the beginning, we maybe don't even need to add in the LRAS curve under this new model, this new framework by which we teach monetary policy with the ASAD model. But I did want to show people how it would still work with the LRAS curve. So let's get to it, okay? What we're doing right now is we're trying to show restrictive monetary policy. And I want to take a moment just on that, okay? I really like the term restrictive monetary policy. A lot of people in the financial sector do use the term restrictive far more than contractionary. When we use the term contractionary monetary policy, we're basically saying the Fed is trying to contract the economy, something they're almost never trying to do. What they're really trying to do is restrict growth, okay? Allow growth to happen, but restrict it, restrain the growth. So restrictive, we think, is just a much better term. It has a much better connotation for the students as they learn about monetary policy. And if you're lost at all, when they do restrictive monetary policy or contractionary monetary policy is when the economy generally is booming and we have an inflation issue where the inflation rate is higher than their target. And that's what's been going on in the United States for the last couple of years as we shoot this video in May of 2024. So here we've got the Fed following a restrictive stance, okay? Now, under the new paradigm, what we'd like to see is an AD original, which we always go with as an AD original showing the original position of the economy, but then two additional AD curves instead of just one. One AD curve showing where AD would eventually go if we went with what's called R star, the neutral interest rate. That interest rate that in the long run will be at full employment and we have no inflationary pressures. And what I mean by that is no pressures for the inflation rate to increase or decrease, and no pressures for the unemployment rate to increase or decrease. This R star, again, it's called a neutral rate of interest. And what it means is the Fed, if they go with the R star interest rate, are not being accommodative or expansionary, nor are they being restrictive, i.e. contractionary, okay, if they go with the neutral rate. Then I've got ADTR. TR is the target rate. It's what the Fed is currently targeting for the federal funds rate, which is their policy rate that they use to change interest rates in the economy. Now here what I've got is a targeted rate that is above R star. So important to understand as you look at this, okay? This is a targeted rate above R star, so they are being restrictive. They're restricting growth, right? They're trying to get interest rates above what they'd be if they were at their neutral rate, and that's going to restrict growth. You can see we're still going to get some growth, right? AD is still shifting to the right, but they're restraining it. If we went with the R star or the neutral rate of interest, AD would increase by more. Total spending would increase by more. Now let's bring in that additional complexity, the LRAS curve. And by the way, here at Econ Busters, we love to draw the LRAS curve red, and that's because LRAS is really just a reference line. It's referencing full employment. So let's go ahead and put that. We've got our YF, full employment output original, and YF in the future, which we go with YF1, okay? And at Econ Busters, we do like 0 to 1 instead of 1 to 2, but that's fine. If we stay with 1 to 2, that's okay too. But just anyhow, 0 is the present, 1 is the future. And what you see is you see presently, right, that AD0, YF0, that LRAS, let's put that 0 in too right there. All right, you can see that we're booming. Presently, we are on the right-hand side of the LRAS curve. Now, the R star in the long run would be that rate of interest that would bring about full employment output. So where ADR star is intersecting SRAS is right where the LRAS curve is coming through, right? So right at the LRAS curve, i.e. the new full employment output. But you can see we're being restrictive. Yes, right now we're booming. So you have, again, it's a complex graph, but we can, I think it brings a lot to light, right? Is AD0, LRAS0, YS0, that right now you can see the booming in the economy, that we're on the right-hand side. But if we stayed with our current targeted rate long term, if we stayed with it long term, we would end up on the left-hand side of the new LRAS or that future LRAS. That's again, if we stayed with the target rate long term. Now, what I really like about this is this really kind of shows students why the Fed will eventually begin to cut rates when they have been restrictive. And as they cut, they will remain restrictive until they get to R star, but that they might become less restrictive, right? Of course, they don't want to stay at this particular targeted rate that the model is showing right now for the long run, because it would put us into a recession. So as the inflation rate begins to moderate, get closer to target, they're going to become less restrictive, right? Less restrictive. And what they're going to do is they're going to begin to lower their targeted rate. And as they lower their targeted rate, let me go ahead and grab this right here. The AD curve, where we place it, is it's going to shift to the right. Now, as they lower it, but the targeted rate still remains above the neutral rate, we're still being restrictive, just becoming less and less. So you can see why they would go through a series of rate cuts, bringing us from our targeted rate to the R star, okay? So again, they would keep lowering the targeted rate to try to bring us closer and closer to R star as we get closer and closer to getting rid of what they're trying to get rid of, which is probably these high inflation rates. So again, just take a look at it. You can see initially what we've got is a equilibrium that's on the right hand side. We got that booming economy, we got inflation rates as a problem. But then if we go with the targeted rate, eventually LRAS is going to be to the right, somewhere to the right, going right through where ADR star hits the SRAS curve right there. And if we stay with our targeted rate, you could see we would eventually have a recession. And that's why we want to become less restrictive over time, lower the targeted rate, allowing AD to shift to the right. Again, a bit complex, but I think our students can handle it, okay? And I think that's the really important thing. We want our models to show what's happening in the real world, to show some of the nuance and the complexity. It's a bit complex, but it is something students could absolutely get their head around with the proper teaching. Anyhow, I hope that makes sense to you. Hope you kind of think about that way of teaching monetary policy with the ASAD model. Of course, this is restrictive, not accommodative, and we can talk about accommodative too. I have some videos on that. Anyhow, hope that makes sense to you. We'll see you in the next video.